Hello and welcome to another financial analysis video. Today we're taking a look at Citigroup on the Stock Array website. They reported earnings last week, and in that earnings data there was no balance sheet or cash flow information, but based on what we know about the earnings, I think we can basically see that Citigroup is currently very undervalued, even compared to some of our other big banks. So we look at the earnings report, we see that Citi beat by 1 cent, $1.06 per share versus $1.05. The big takeaway from this chart here is taking the 2015 quarterly earnings and comparing it to the same quarter of the prior year, and you'll see that Citi handily beat each quarter's earnings, and that's very good, a very positive outlook for Citigroup. As we look further down, we did not have the balance sheet information. However, the model automatically inserts the prior quarter's balance sheet information so that we could do some calculations based on what data we do have. Looking at debt to equity ratio, you could see that Citi had continued through Q3 to delever. I would be very interested to see what the fourth quarter metrics look like there. I expect continued deleveraging. Based on the third quarter equity numbers, we could see that the return on equity for Citi continues to rise. I expect that final number to be around 7% when I plug in the final information. Continuing on, we see earnings are growing for Citigroup. While revenue continues to decline, it's tame. It's also part of a process where Citi is deleveraging, selling assets, etc. So as long as you don't see market declines in revenue, there isn't much of an issue there. And really, if you look at it on a quarterly basis, it has bottomed out. The fourth quarter actually had an increase in quarterly revenue for the first time since the third quarter of 2014. Really, the big thing that should draw people's attention in terms of Citigroup is the fact that it's now trading at, close to 50% of book value. And, it really moved down with the marketplace, which was unwarranted in my opinion, considering the fact that we have slightly higher interest rates, which should benefit banks, and there's no catalyst out there that suggests that Citi is going to be severely hurt by the market downturn. They've weathered energy pretty well. They are a very big bank, so they are pretty broadly diversified. However, one of the downsides of being a very large bank is that it's a very complicated business model. We could see here that on a price to earnings ratio mark, they're down now to about 8 times price to earnings. So really a large amount of value emerging here. This is a 3-year beta that I use to just track trends to suggest where Citi is in relation to the marketplace. I don't think that's relevant for this analysis, but overall, I believe that Citi is poised to recover from this $41 mark and to recover quicker than other big banks. I hope you enjoyed this video. Happy investing.